I'm John Kosar, Chief Market Strategist at Asbury Research. Thanks for viewing our latest Following the Money podcast. Today's date is Sunday, March 24th, 2024. Today I'll be talking about what Asbury Research's latest data-driven market research and quantitative models are saying about current financial market conditions. That is, when to be on offense and looking for opportunities, and when to be playing defense and protecting your capital. Asbury Research provides investment research services and money management to individual and professional investors. For more information, visit asburyresearch.com and use the contact tab, or just click the link in the description of this video. Finally, if these videos are useful to you and you'd like to see more of them, please like and subscribe. It helps us to get in front of more people just like you. Now let's follow the money by identifying some key areas of our focus for this upcoming week. Number one, Asbury Research tactical models remain positive. Through Friday, our Asbury 6 risk management model remains on a February 7th positive status, while the S&P 500 has risen by 5% since then. Through Friday, 5 of the Asbury 6's constituent metrics are green or bullish. Let's take a look at those now. We're going to go into the Research Center, and we're going to scroll down. Here's where all of our models are updated. We're going to look at the Asbury 6 today, and here we are. The Asbury 6 is a model that I built maybe 6 or 7 years ago. We kept it internal for a while. The reason I built the model is because the day-to-day volatility in the market was starting to really increase to the point where it was very easy to make a mistake, to get shaken out of a good idea in the market, because you had 2 days where the S&P was up 50 and then 30, and then the following day it's down 70. And you're rethinking all of your analysis and wondering if you missed something. So we look at this every day, and it focuses on 6 diverse ways to measure the internal strength of the market. We look at the rate of change in the S&P 500, the relative performance between stocks and high-yield bonds, investor asset flows, volatility, trading volume, and market breadth. We actually took a big basket of tactical tools that I've been using throughout my time in the markets, which began in the 1980s on the trading floor of the Chicago Mercantile Exchange, to try to find 6 that were disparate, that were different from each other, and they tended to kind of pick each other up as a team. When 1 or 2 were giving a false signal, the other 4 would come in and make sure that you were understanding the internal health of the market in an accurate way. So right now you see 5 or 6 of them are green or bullish. These numbers here, the cells, those are the dates that those particular constituents of the A6 turn green or positive, or turn red or bearish. 5 or 6 are positive right now. Again, it's been positive. The indicator itself, meaning 4 or more, have stayed green since February the 7th. Market's up about 5%. Since then, it would take 4 or more of these to turn red to indicate to me, and according to the model, which we've backtested, that internal elements of the market are weak enough now to facilitate some kind of a correction lower. The second one that we're going to not look at today, but we're going to talk about, is the CPM, or the correction protection model. That's also available in our research center here. The CPM has been on a risk-on status since November the 2nd, and the S&P 500 is up 22% since then. The CPM is our wealth preservation model, which historically has closely stuck with the S&P 500, but avoided the big drawdowns that we've had. So what you're getting is a model that sticks to the S&P 500 pretty closely, but with significantly less drawdown. For example, the maximum drawdown over the past 6 years in the S&P has been 34%. In CPM, it's only been 20%. When the CPM turns to risk off, whenever that may be, that's going to be our cue that this very strong bull market that we are in right now has started to weaken internally and is very vulnerable to having a corrective decline. The third thing that we want to look at, by the way, there's more information and details about all of the Asbury Research models by visiting asburyresearch.com here and simply going to the models slide. This is the models page here. There's a lot more information about all of our models, including the CEIF model, which we're going to talk about next. Our CEIF model is CEIF is an acronym for Sector ETF Asset Flows. It measures investor assets that are moving around the 11 sectors of the S&P 500 via looking at the State Street sector spiders. And it looks at them in 3 different time periods, and we've built a model that measures the acceleration of money either moving into or out of those 11 sector spiders in 3 different time frames. Part of the CEIF model is displaying those signals through what we call rainbow charts. We're going to look at a couple of those today. The first one we're going to look at is for the energy sector. By the way, in the CEIF model this week, the top 2 sectors in the CEIF model in terms of a favored ranking are energy and industrials. So here's energy here. Up on top here, this top panel shows the CEIF model ranking for energy going back over the past year for either favored, which is green, neutral, which is yellow, avoid, which is red. So what we're pointing out is the important part of this chart to understand is that from November 8th to February 9th, energy, it was in an avoid ranking according to CEIF. You can see it from here through here. During that period, XLE had underperformed SPY. That's the chart down here. This is the relative performance of XLE versus SPY, which is, of course, the ETF that tracks the S&P 500. So during this period that XLE was in an avoid ranking, XLE had underperformed SPY by 13%. What we see now is a pretty fast acceleration out of avoid territory over the past several weeks. It jumped into a favored ranking on March the 13th, and you can see that has given us this little relative outperformance that we've had so far. As long as energy stays in a favored ranking, this relative outperformance in energy is likely to continue, and we track this via the CEIF model. Here's a good example. Back here last year, let's call this roughly from middle of July of last year through the middle of October of last year, with a few exceptions where we moved into neutral ranking, energy stayed in a favored ranking. That gave us all of this relative outperformance that we saw last year. So this is how the CEIF model uses investor asset flows following the money to make sure that we're in the sectors where the money is going and avoiding the sectors where the money's coming from. The second chart we're going to show you today is the other one that I mentioned that is also highly ranked this week according to CEIF, and that's the industrial sector. XLI is the ticker. And what we see here is that since the end of February, XLI, it moved into a favored ranking. And then we had a little stutter step here, March 14th to 20th, where you can see it drifted into a neutral ranking just for a short period, and now it's back into favored status. That gave us all of this relative outperformance here. As long as XLI stays in a favored status, a favored ranking, we're likely to see more relative outperformance. All we're doing here is following the money. We're not trying to predict what the Fed's going to do or who's going to win the election. We want to know where the money is going. And as long as the money stays in a given sector, we stay also. Again, there's more information about this model if you go to the models page up on top of asburyresearch.com. The next chart that we want to talk about has to do with chart patterns, expectations. How much higher can this go? I get this question all the time. We've moved, I don't know, 24%, I think, off of the October lows from last year in the S&P 500. And I get this question, how much higher can this go? This is one way to determine how much more there may be in the tank for the stock market. This is the Dow weekly going back to the end of 2019. And what this shows is after this big move that we had from March 2020 to January of 2021, we had this coil form on the chart, investor indecision. The market was coiling up and kind of gathering energy, if you will, waiting for enough bullish conviction or bearish conviction to break out of the safety zone, so to speak, here in blue. It did that to the top side on December the 1st. And the measuring objective on this breakout is 41,500. That's 5% higher than where the Dow closed on Friday. Now, the Dow and the S&P 500 have had a very tight and stable linear positive correlation to one another over the past 25 years. So if we're going to hit 41,500, according to the correlation, we should also do equally as well in the S&P 500. So this answers that question. How much higher could we potentially go here until we ultimately have some kind of a corrective decline lower? The last chart that we're going to look at is going to look at this from a little different perspective according to price momentum. And that we have right here via the percentage that the S&P 500 has moved either above or below its 200-day moving average over the past 10 years. So here's the S&P 500 up top with its 200-day moving average going back to 2015. Down here is the indicator. And what it's showing is that through Friday, it's above 12%. It's more than 12% above its 200-day moving average. It's actually about 14 and change. But what we showed here is back in July of 2023, back here in February 2020, when the COVID collapse was just beginning, and it lasted into the end of March. We all know what that felt like. And then finally here in January of 2018, we all had this 10-year extreme of 12% or better by the S&P 500 up above the 200-day moving average. We have that now. What does that mean? It's a condition rather than a signal. It's telling you historically the market is a little bit over its skis, or actually it's a lot over its skis historically. If you're looking at this particular metric, what does that mean? It means when we ultimately have a correction, because we're overextended, it's likely to be larger and maybe a little bit more violent than one would normally expect to occur. How do we know when that happens? When the Asbury 6 turns 4 or more to red, and or the CPM goes to risk off. Until then, we've got an unmet target 5% up above the market in the Dow. So finally, for those who like to follow me around and Asbury Research around the media, this past Friday, which was March the 22nd, I did an interview with Jim Puplava of the Financial Sense website. Jim has had this website for a long time. He's got a lot of the top analysts on there. I was fortunate enough to be interviewed on Friday. It's about 20 minutes long. You could find that interview at financialsense.com, or you can go up here to the media page, and we also have it on our own website. This Tuesday, March 26th, I will be the guest presenter on StockCharts.com's Your Daily 5. I do a Your Daily 5 for stock charts about once a month, and my next one is going to be this Tuesday afternoon. On Thursday, April the 4th, I will be interviewed by Chuck Jaffe of Money Life. Money Life's a national business and financial radio show, and you can find that interview on April the 4th at moneylifeshow.com. So that wraps up our Following the Money podcast for this week. Our next Following the Money is tentatively scheduled for Sunday, April the 7th. Also, for Asbury Research subscribers, our next 90-minute teach-in via Zoom will be on Saturday, April the 6th. So make sure you reserve your spot when you get your email invitation from us, which will be about the middle of next week. Hope to see you here again soon, and please don't forget to like and subscribe. Have a great Sunday.